This is where we left off in the first video. We'll then continue. So this custodial fund for special assessment debt service. So where we looked at, this is very similar to what we looked at in chapter 6, where we had a special bond issue that was just for street improvement projects. And then we recorded that debt service for that bond issue. So we have that we bill the property owners for the assessments, collect the installments of assessments, interest, and then we pay for that assessment. The transactions are very similar to those in Chapter 6. We're just looking at a special assessment debt. You would have additions and deductions rather than revenue and expenses. Okay. Another type of custodial fund is a pass-through custodial fund. This would be an example of a grant, an entitlement, or a shared revenue from federal or state governments that often pass through before distribution. So, of course, we have what is the type of involvement? Is there a direct financial involvement? Is there an administrative involvement, such as you get to say how those funds are distributed. It could be that, the state receives a grant and then distributes that grant out they could receive a grant from the federal government, and then they distribute that grant out to city governments, and the state does not get that grant themselves. They are just the pass-through account for distributing those funds from the federal government. So when we are trying to decide if there is a relationship or if we have administrative involvement or financial involvement, that's where I said, if there is some monitoring, that there's compliance with program requirements, such as specific deadlines that have to be met, that the money can only be spent in certain ways, that the city government has to provide a report, if they decide what the eligibility is, so there's an application that governments have to do to the state in order to receive these special funds, or if they get to decide any discretion and allocation of funds, such as the amount that goes to each city government. So if these things exist, then we have to account for it a little bit differently than if we were strictly a pass-through account. So when these criteria are met, then the primary recipient government, so in this case we're talking about the state, has to recognize a revenue and an expenditure or expense for the transfer. If either one of these, neither administrative or financial involvement exist, then it is strictly a pass-through custodial account where we record additions and deductions, and there is no revenue or expenditure or expense recognized. So it really just kind of depends on that relationship, what the exact accounting treatment is. When we report custodial funds, so we report financial statements, we have a statement of net position, so the assets and liabilities, and then we also have changes in fiduciary net positions. So what are the additions? What were the deductions? Usually aggregated in one column. So if we have multiple different kind of custodial funds, we would add all of those custodial funds together, put them in one column in our citywide financial statements. The only difference would be if it's an investment pool, which we're going to talk about. An investment pool is reported in a separate column. An investment pool is a type of custodial fund. And then only financial information for external parties is reported by custodial funds. So really just notes the financial statement, what the fiduciary funds are for, and whether or not the fiduciary funds are included in the total in the general fund and governmental activities, or if they're fully kept separate from those. Okay, so we're going to talk about this investment trust fund. So trust funds account for assets received by the government under a trust agreement. We have an investment trust fund, a private purpose trust fund, and then pension trust funds are the different types that we're going to talk about. These are also fiduciary activities and can be forms of custodial accounts in which the government doesn't just manages the funds. They don't actually own any of the funds or own the assets. They're really just managing the accounts on behalf of a secondary party. Okay, so we have these different kinds of funds and trust funds. So we have a special revenue fund, a permanent fund, and a trust fund. So a special revenue fund could be for any kind of program or citizenship. It can be donated funds. It can be funds that are part of a bond issue or part of a tax levy. And then the government can spend all funds in that account however they want. Okay, then we have a permanent fund. A permanent fund is sometimes also called an endowment. An endowment is also created to benefit programs or citizenry, but the idea between an endowment is that part of the capital is restricted or permanent. This is often called the principal or the corpus. So for example, if I donated $1 million to the city of Waverly for Parks and Rec activities, and I said it could be used however the government wanted, then that would be a special revenue fund. It has a specific purpose that I, as the donor, have identified, but I have not put any restrictions on what can and can't be spent. For a permanent fund or an endowed fund, that corpus or principal, so that $1 million gift, is restricted. That $1 million gift can never be touched or spent. That $1 million has to be invested, and only investment earnings on that $1 million can ever be spent. Okay, and then we have a trust fund, and it benefits those other than the government's own programs or citizenry, and then whether or not what we can spend out of that trust fund, whether it can only be earnings or it can be earnings and principal, depends on the trust agreement. The complication of these accounts, and we're going to talk about these accounts again in the nonprofit section of this class, because these also apply to nonprofits. They just have a little bit different accounting treatment, but the core rules are the same. This agreement. So every single one of these where someone gifts money or creates a special purpose fund and dictates how it can and can't be spent is a legal contract. if you have 100 of these, they can have 100 different rules and regulations because each individual one is a legal contract. And so the management of these funds and maintaining that legality can actually be a full-time job, especially at like in higher education institutes. This is often the management of endowment funds is just a full-time job, making sure that all of those legal requirements of each individual fund is carried out exactly as stated within the terms. Okay, so an investment pool. An investment pool will be governments might have idle cash that they decide to invest to collect earnings on as a way to help boost their earnings potential and have extra money. This is just smart cash management. Any extra cash should be invested. That is true whether you're a government or a corporation or a nonprofit or an individual. It's not good to just sit on lots of cash. It's better that that cash is making money for you. So we have investment pools where governments can pool their funds together and then use an investment manager. Some have an internal investment manager that they maintain, and then others will use a professional group outside of the organization. So they'll partner with somebody who actually does a financial advisory company that actually manages these investments. You create a trust agreement and they get reported as investment trust funds. If we don't have a trust agreement, then it is just a custodial fund. So it depends on what that legal agreement is. Okay, so we have this example of an investment trust fund in the chapter. We have earnings and pooled investments. What we do is we record the changes in the account. Of course, GASB defines fair value as the amount at which an investment could be exchanged in a current transaction between willing parties other than a forced liquidation sale. So for example, if that investment trust fund is invested in the stock market, then the fair value would be the fair value of all of the stocks in the investment portfolio. Of course, when we're looking at division of earnings and changes in fair value, we have to revalue fund assess assets whenever contributions or distributions occur. So even though the stock market fair value changes on a daily, sometimes hourly basis, we really only look at those fair value adjustments when contributions or distributions occur. Until then, they are just additions or deductions from the fund. Okay, so we have this example here where assets have been created in a Campbell County investment fund where we have 2 debt service funds and then a capital project funds that have their current amounts invested. So for example, in a debt service fund, we are collecting money like a savings account to pay a future debt, to make future debt payments. And what we're doing here then is investing those accounts. So we also earn dividends and interest on them. So the distributions of those happen at a percentage value of how much that is worth. So of course we have here the fair value has changed considerably. And I would say that this is a typo here. because the difference between 3 million and 13 million is a lot more than $52,000. But the earnings, so we have accrued interest and then change in fair value, where if that entity then wanted a distribution for some reason, they could take that. We'll continue this discussion in the next video.